Inflation is back, but that's not the big news today. We're going to show you which market reacted violently to the CPI data and what this means for future stock prices. Today, the consumer price index on a year-over-year basis, it rose 3%. That's the highest rate of return since about May of last year. That's not good. Core CPI, excluding food and fuel, that's a 3.3%. That's in line with where we've been over the past couple months, higher than where we want to be though. Now, in blue, core CPI. In yellow, the standard CPI. The difference between the two, core CPI, again in blue, excludes food and fuel, while the CPI data in yellow includes those more volatile components. And we can see, including especially fuel, it's on the rise. We're going to show you in just a moment why exactly that's happening. Here are the different components within the CPI. On a year-over-year basis, airline fares up 7%. Meat, poultry, fish, chicken up 6%. Owner's equivalent rent up 5%. Shelter up 4%. So what does it all mean? Here's our take. Inflation is hot, and it looks like it's getting hotter. Today's report came in as a surprise to many, but it's not our fault. We were lulled into a false sense of complacency by weak energy and car prices. But that's just not the case anymore. Used car prices and gasoline are now on the rise. Somehow, inflation didn't seem that bad as long as used car and energy prices remained suppressed. How significant was today's number? The market always has the answer. 10-year bond yields soared under the expectation the Fed will not and should not cut rates anytime soon. Speaking of the Fed, Powell said today, in an appearance before the House lawmakers, "I would say we're close, but not there on inflation." You may remember our video where we discussed the SAM rule. It was a while ago. Well, Claudia Sam, chief economist at New Century Advisors and former Fed economist today, she said it really does push a timeline into the second half of the year if things go well. But the real action today was not in stocks, nor gold, or even those fiery treasury yields. The big move today was in the Fed funds futures. The market is now forecasting no change in interest rates going all the way out to July this year. Needless to say, the futures market is not taking today's number lightly. So what does this mean for all of us? We all want to know what is going to be the future in the stock market. Historically, stocks have done quite well when the odds of a rate cut dissipate. Why, may you ask? The futures market's telling us inflation is hot, but don't worry, the economy can handle it. So if history's any guide, stocks should fare well, unless of course other numbers like jobs, GDP, etc., if they start to sour. Upon receipt of today's CPI data, Fed futures on the June contract spiked higher, indicating a diminishing chance the Fed will cut rates. Go back to late November. The same Fed futures contract spiked higher, and stocks began to rally shortly after. The same pattern repeated in December. And if history's any guide, perhaps stocks will embark on another challenge of new highs. We took a poll recently as to what should be the Fed's next move. At the time, 67% voted for no change, 20% said the Fed should cut rates, and 13% voted to raise rates. We're going to launch a brand new poll. Same question. We're going to see how much a sentiment may have changed based on today's CPI data. We hope this has been helpful. We look forward to seeing you back soon.